We are witnessing a severe depreciation of the Japanese yen. Global investors are reacting with significant concern, and trillions of dollars are being repositioned worldwide as Japanese authorities intervene to stabilize their currency. However, this is far more than a national economic crisis. A much larger strategic shift is occurring behind the headlines. Concurrently, China is executing calculated maneuvers against the G7-led financial order. While public attention remains fixed on the yen's decline, Beijing is strategically leveraging this period of instability to advance an alternative financial framework, one with the potential to undermine the Western-dominated system that has governed global finance for decades. The critical question, therefore, is this: what are the implications for Japan, for China, and for the wider global economy? In this analysis, we will uncover how Japan, once an undisputed financial powerhouse, became ensnared by its own policy decisions. We will examine how China is employing currency diplomacy, trade agreements, and digital finance to reconfigure international power structures without resorting to military conflict. Furthermore, we will assess the potential consequences for global investments, employment markets, and the cost of living for ordinary people. A point largely overlooked in mainstream discourse is that Japan's challenge is not merely a weak currency, but a profound crisis of confidence. For years, the Bank of Japan maintained interest rates near zero, even as other major economies began tightening monetary policy. While this made borrowing inexpensive, it rendered the yen decidedly unattractive to international investors. Capital naturally migrates towards higher returns, and with the United States and Europe offering substantially better yields, money has flowed out of Japan, accelerating the yen's downward spiral. There is another, more perilous dimension to this situation. Japan is one of the world's largest holders of United States debt. Should Tokyo be forced to liquidate a substantial portion of these assets to fund its currency defense, the reverberations would be felt across global bond markets. This is not an issue confined to Tokyo. It directly concerns Wall Street, the City of London, and every major financial hub. Now consider China's position. As Japan contends with these currency pressures, Beijing is actively constructing parallel financial infrastructures. It is expanding the use of the renminbi in international trade settlements, developing payment systems that bypass traditional Western networks, and piloting a digital currency designed to reduce dependence on the US dollar. This is not a reactive measure. It is a long-term, deliberate strategy for which the current global instability provides a perfect catalyst. Another frequently missed detail is the domestic double-edged sword of a weak yen. While it makes Japanese exports more competitive, it drastically increases the cost of essential imports like energy and food for Japanese citizens. This squeezes household budgets, erodes purchasing power, and fuels public frustration. Such social and economic pressures can, and often do, precipitate rapid political change. In the following segments, we will demonstrate how modern currency conflicts are waged not with weapons, but with interest rates, trade flows, and financial alliances. We will trace how a national crisis can trigger ripple effects across global technology markets, energy prices, and international supply chains. And we will explore why a growing number of analysts believe this moment could signify the dawn of a new financial era, where the G7's authority is no longer absolute. For years, the Bank of Japan has persisted with an ultra-loose monetary policy, keeping interest rates at or below zero. While other central banks aggressively raised rates to combat inflation, Japan held its course. The stated objective was to stimulate growth and maintain cheap credit. However, this policy also systematically eroded the yen's appeal. International capital follows yield, and Japan's refusal to align with global trends initiated a steady, persistent capital outflow. This prolonged era of easy money also fostered an addiction to government debt. Access to cheap financing enabled the state to borrow excessively, resulting in Japan now carrying one of the highest public debt to GDP ratios in the world. Compounding this, the country's economic growth has remained stagnant. Wages have been flat, consumer spending has been weak, and corporate investment has been cautious rather than dynamic. Underpinning these cyclical issues is a profound structural problem. Japan's population is rapidly aging. A shrinking workforce entering the economy is coupled with a growing elderly population reliant on state pensions and healthcare. This demographic reality places unsustainable long-term pressure on public finances and national productivity. A smaller labour force inherently means lower potential growth. Astute investors are acutely aware of these trends, and their confidence is adjusted accordingly. We now turn to the Japanese government's recent policy announcements. Tokyo has unveiled a new series of stimulus packages, committing to significant fiscal expansion. This includes increased support for households, further funding for industry, and substantial public investment. In principle, such measures are designed to stimulate a stagnant economy. However, the market's interpretation has been markedly different. Investors perceived not a cure, but a heightened risk. The calculus is straightforward. More government spending necessitates more debt. To service that debt, more currency must effectively be created. An increased supply of yen, in turn, devalues the currency. Acting on this logic, traders accelerated their selling. Their concerns were clear: a fear of unchecked inflation, a loss of fiscal discipline, and a conviction that Tokyo was prioritizing short-term political relief over long-term economic stability. With each new signal of government spending, the downward pressure on the yen intensified. The result was a precipitous decline. The yen lost a substantial portion of its value in a remarkably short time frame, breaching multiple key levels against the US dollar that many analysts believed would hold for years. The velocity of this collapse sent a shock through currency markets. Such a rapid devaluation is almost unprecedented for a major, developed economy. This was not a controlled descent. It was a series of cascading sell-offs, where automated trading algorithms amplified the momentum. And human sentiment followed, creating a self-reinforcing cycle of pressure. In response, Japanese officials began issuing increasingly stern warnings. They signalled they were monitoring the markets closely and hinted at the possibility of direct intervention, a move that would involve using their foreign reserves to buy yen and artificially support its price. There were also suggestions that a shift away from their long-standing ultra-low interest rate policy might be imminent. These verbal interventions did provoke brief technical rallies, but these recoveries proved fleeting. The market had moved beyond reacting to rhetoric. It was now demanding concrete, decisive action. The real crisis, however, is that the economic damage is already being felt on the ground. A weaker yen dramatically increases the cost of imports. For a nation as reliant on foreign energy, fuel, and raw materials as Japan, this translates directly into higher bills for electricity, petrol, and food. This squeezes household budgets as stagnant wages fail to keep pace with the rising cost of living. The business sector is not immune. Small and medium-sized enterprises, in particular, are grappling with soaring input costs. Some are forced to pass these on to consumers, fueling inflation further, while others absorb the losses, jeopardizing their viability and the jobs they provide. Investors now fear a vicious cycle. If the yen continues to fall, inflation could become entrenched just as consumer confidence plummets. This is a dangerous cocktail for any economy, eroding trust, suppressing spending, and deepening financial instability. But a number of analysts contend this is not merely a Japanese problem. They see it as a symptom of a broader, structural shift in global finance. While the world watches the yen, China is capitalizing on this instability to advance its own strategic objectives. Beijing's approach is not based on public pronouncements, but on the quiet, systematic construction of an alternative financial infrastructure. For years, China has worked to internationalize the renminbi, expanding its use in cross-border trade settlements outside the dollar, launching yuan-denominated financial instruments, and building its own global payment networks to bypass systems like SWIFT. These are not mere technical adjustments. They are calculated, long-term strategic moves. Japan's struggle inadvertently provides China with leverage. When a G7 economy of Japan's stature faces a currency crisis, it inevitably raises questions about the stability of the entire Western-centric financial order. Investors begin to question old certainties, seeking new hedges and diversifying their currency exposure. Central banks in developing nations are already making gradual adjustments, some increasing their yuan reserves, others signing commodity deals that bypass the dollar entirely. This realignment does not happen overnight. But when confidence in one system is shaken, the opportunity for an alternative to gain traction expands significantly. One potential path forward is, of course, direct intervention by Tokyo. The authorities could enter the currency markets to buy yen, or they could finally enact a substantive interest rate hike to make the currency more attractive. Such measures might staunch the bleeding and even engineer a short-term technical recovery. However, market intervention is a tactical tool, not a strategic solution. If the underlying issues of weak growth and soaring public debt remain unaddressed, the fundamental pressure will inevitably return. History shows that markets will repeatedly test the resolve and the resources of any central bank that stands in their way. There is, however, a more perilous trajectory. Should investor confidence evaporate entirely, we could witness a full-blown rout. The yen would enter a steeper decline, driving import costs to unsustainable levels. Given Japan's profound reliance on imported energy and food, a weaker currency acts as an immediate tax on the entire economy. The result would be a deeply damaging economic squeeze, inflation surging while wages remain stagnant. This erosion of purchasing power forces households to retrench, consumer spending to contract, and business revenues to fall. Confidence plummets, creating a negative feedback loop that places severe strain on the entire banking and corporate sector. But the implications extend far beyond Japan's shores. A profoundly weak yen, coupled with China's expanding financial influence, could accelerate a fundamental realignment of the global economic order. We may see trade partners begin to hedge their exposure to traditional G7 currencies. Other Asian nations could seek new financial arrangements with Beijing and regional blocs. The ripple effects would be immediate and widespread. Capital flows would shift direction. Global supply chains would face renewed pressure as currency volatility hits exporters and importers across the continent. Investment would become more cautious, risk premiums would rise, and the very predictability of international trade would be undermined, with smaller, trade-dependent economies feeling the impact first. For the global investment community, this introduces a profound sense of uncertainty. The rapid devaluation of a major currency like the yen shakes the foundational belief in traditional safe havens. Investors are compelled to ask whether these established stores of value can still be trusted in a crisis. As confidence wanes, capital begins migrating, not just into other currencies, but into gold, alternative markets, and novel financial instruments, forcing a wholesale re-evaluation of long-held portfolio strategies. Furthermore, the risk of a regional currency war becomes significantly elevated. As Japanese exports become cheaper, the competitive pressure on economies like South Korea, Taiwan, and Southeast Asia intensifies. In response, these nations may feel compelled to allow their own currencies to depreciate to protect market share. This creates a dangerous domino effect, a race to the bottom where multiple currencies devalue in concert. The consequence is imported inflation spreading across the region, making everyday essentials more expensive for millions. The impact on global commerce would be equally transformative. Corporations would be forced to fundamentally rethink their supply chains, seeking to mitigate currency risk. Some would shift production, while others would renegotiate contracts in alternative currencies. For large multinationals, aggressive financial hedging would become a core business function, while smaller firms would be battered by higher transaction costs and extreme price volatility. In essence, the collapse of the yen is more than a market indicator. It is a signal of deep structural stress within the Japanese economic model and a sign of fissures in the post-war global financial architecture. For decades, the system was shaped by G7 nations and their currencies. Now pressure is mounting from new systems and new alliances. What we are likely witnessing are the early stages of a genuine financial shift, not a temporary fluctuation. This story is still developing. The next decisions taken in Tokyo and Beijing and the subsequent moves by international investors will have consequences that resonate through global trade, capital movement, and ultimately, the balance of international power. The adjustment may be gradual, or it could be sudden, but the direction of travel is now clear.